Thank you. My name is Jack Miskunis. Welcome to the discussion on asset management. My colleagues over here, Miles, Andy, and Hugh, will take a minute to introduce themselves. But myself, I'm the asset management captive insurance advisor at Oppenheimer. I've been working with offshore captives since 1991, and I was kind of making a mental note of myself. This is the 20th anniversary of my coming to this conference. Gentlemen, you want to take just a second to introduce yourself?
Yeah, sure, Jack. Good afternoon, everyone. My name is Miles Ziblock. I'm the Chief Investment Strategist for 1832 Asset Management, which is a subsidiary, a management arm for Scotiabank. We have about $190 billion in assets under administration, $110 billion in assets under management. And so I lead a team of about 70 or 80 global portfolio managers around the world.
Who are you?
Oh, me? Hi, everybody. Andy Barron. I'm the Chief Investment Officer for Butterfield Asset Management. It's the asset management sub for Butterfield Bank, which you've probably seen. We are an asset manager that has a practice specifically targeted at captives on the institutional space. I've been doing it for about 14 years offshore in Bermuda.
Market? Is that the word you were looking for? Market? Bermuda market. Oh, you just turned it over to me. You're done.
Yeah, I'm done. See you.
I've presented with him for too long. I can finish his sentences. Like Andrew, I am in Bermuda as well. My name is Hugh Barrett. I'm chairman and CEO of a company called PRP Performa Limited. Like the Cayman Captive Forum, celebrating our 25th anniversary in business. We're a bit unique in that all we do is manage money for captives. We run about $4 billion in assets, so a little bigger than my gentleman to the right. And he said $100 billion, so I guess I'm a little smaller. But we run money for captives in Cayman and Bermuda. We have an office in Charleston, South Carolina, and also one in Burlington, Vermont.
Great, thank you all. So let me just start out by saying I feel that the last few years have really been historic in many ways. And I think if I stood up here 2 years ago and I told you that my prediction was that the UK was going to leave the European Union, that the USA was going to drop out of or threaten to drop out of virtually every significant trade and client agreement, that Russia would be caught using Facebook to influence elections in the Western democracies, and oh yeah, by the way, that Donald Trump was going to be president of the United States, I think you would have laughed out loud. Especially if after I said all those predictions, I also predicted at the same time that the stock market today would be hitting all-time highs, the bond market would be at all-time highs. And yet this is the world that we live in, and this is, as captive managers and owners, this is what you need to navigate. These are the waters in which you have to run your company and invest your assets. Now, everyone seated here to my left has held the Captive 101 lectures, and they've discussed everything that you can see on this slide over here. And those are not the things that we're going to be discussing today, because we're going to assume that your captive's already formed, that you already have assets to invest, or that you're already invested, and that you're here to hear our thoughts on the markets, where we see opportunities for investing for captive assets today, tomorrow, and of course in the near future. So I invite everyone here to ask questions along the way. I did put copies of the presentation if you want to make notes on them, because these slides are designed to provoke discussion. So let's begin. I actually throw the first question to Hugh. Captive owners, looking at this list of things, because you've given this talk as recently as yesterday.
So I thought we weren't going to talk about it.
They have a lot to consider. And how important, in your opinion, is asset management, and are captive owners paying enough attention to it?
Sure, thanks. You're right. We did cover this yesterday. I think that all of the noise that is in the world, certainly probably more now than ever, that Jack just mentioned, the geopolitical risk, et cetera, it's important. But when it comes to managing money for captives, you want to somewhat ignore all of that, at least at the beginning, and make sure you sit down with your captive manager, with your portfolio manager, put together the investment policy statement. As Jack mentioned, asset allocation certainly is the most important decision that you're going to make for your captive going forward from a portfolio management standpoint. It's all about how much risk you could take. It's all about what portion of the portfolio you can look at long term, and as a result, invest in things like equities. If you can't take a long-term look with any of the assets, then don't put anything in equities. So it's very important that that you spend some time putting that together and making sure that that process is dynamic, making sure that you don't just put these guidelines together and then ignore them for the next 10 or 15 years, because the risk tolerance of the captive, the maturity of the captive, all of that's going to change, and you're going to want to change your guidelines accordingly. So that's the most important decision that you'll be making, not about market timing, not about what's going on in the world, but about how effectively you can manage the assets of the portfolio based on the captive's risk tolerance.
Great. And so one of the things you mentioned was political risk, and certainly that's an area of concern. So we've got North Korea, who as recently as yesterday just launched a missile that can allegedly reach anywhere in the United States, and as far as I could see, Bermuda and the Cayman Islands. We've got Brexit going on. There's a nice picture there. And of course, we have rising political extremism. I don't expect you to read that, but these ultra right-wing parties, nationalist parties. So uncertainty and risk are everywhere. I'd throw this to Andy and say, do you think that captive owners should be concerned about global geopolitics? Should that be their focus or not?
No, I don't think so. I don't think they should be at all. I think they should be taking the long view of this. The reason, the picture on the right-hand side is actually something that I contributed to this presentation, whatever we got going here. This is from more than a year ago. So these are all the things that everybody was worried about more than a year ago. So about, sort of 15, 18 months ago, everybody was talking about the rise of the Austrian Freedom Party and the French National Front. I'm pretty sure we all know what happened in the French elections. They elected an academic economist as their leader, and they look to be, reforming the country's labor laws as we speak. So that's what everybody was worried about back then. And nothing has happened about that chart. So I think people should be less focused on it, in actual fact.
Maybe he's changed his hairstyle.
What's that? Who?
Maybe he's changed his hairstyle. Maybe that's the only thing that's changed.
Boris? Well, Boris never changed it. I wouldn't go so far as to call it a hairstyle.
Yeah, I know.
But I shouldn't talk. Anyway, so the one thing on this,
Easy, guys.
the one thing on this.
It's late in the day.
The one thing on this page that I think does matter is the I guess sort of the Brexit part, for lack of a better term, the Boris Johnson picture as the leading pro-exit politician in the UK. This does matter for me. The economic implications matter. The geopolitical implications matter zero. The UK is frankly not that important to the geopolitical balance of the world, nor are they that important to the economic structure of the world. But symbolically, their exit from the Eurozone is a step backwards for global trade, a step backwards for integration, a step backwards for people in the country who consider themselves part of Europe, and I don't think it can do anything good for the country, basically. So, if I had to pick one thing that was a problem, that would be the one. Just in terms of North Korea as well. Some of the people that we read about North Korea, I'm no expert in North Korea. I mean, you can't be an expert in everything. I know quite a bit about bond markets, but not so much about North Korea. But some of the people that we read have been talking about especially the most recent, missile launch as being basically the completion of the strategy of North Korea's, sort of intention to remain on the world stage and remain a regime. So if you think about it, if you assume that they're not crazy enough to launch nuclear weapons at, Washington D.C. or wherever they decide to, pick your place. If you assume that they're not, and that what they really want is for their regime to survive, there's basically two necessary conditions for that. The world has to believe they have nuclear weapons, which the world clearly does believe that they do because they've been testing them, and the world needs to believe that they can deliver them somewhere else, right? Apart from their own, underground facilities. So they've essentially satisfied those two requirements with this last test. And in fact, the leadership said after this test that they've completed their testing. What that says to me in some ways is they have proven that they can survive as a regime and they don't have to do anything else.
Well, let's hope that's true.
Jeff, there we go.
This is a little gallows humor from the stock market, where during the Cuban Missile Crisis, and literally there were nuclear weapons right around the corner. The stock market was crashing, and one of the traders went to his boss and said, "What should I do? The market's crashing." He says, "Keep buying, because if they set off the bombs, you don't have to pay for the trades. And if they don't set off the bombs, the market's going up." But Miles, talking about that, let's.
Well, no, I think that's. I mean, it's giggly, but it's true. I mean, if you look at, I looked at sort of 40 geopolitical events since the 1930s, important ones like the Cuban Missile Crisis, Kennedy's assassination, all that sort of stuff. And what you find is that, that sentiment from the New York Stock Exchange traders, buy it because, if the bomb goes off, we're dead anyway. That really reflects well on what we see in markets over time. So if you look, the typical sell-off in these very scary sorts of environments is 6%. That's the sort of the top to bottom sell-off, and it usually takes 16 trading days to recover that sell-off, which is about almost a month, say 3 weeks in market terms.
And that's historically.
And that's historically.
If you look at the Brexit vote, the market pulled back 10%, and it came back in 3 days.
Yes.
So the corrections are coming faster.
Yeah, I mean, they're coming faster and they're retracing faster. And, if you guys remember, when, the worst thing for markets in world history was Donald Trump getting elected as the President of the United States. And what happened overnight in Japan was the S&P futures were down, they were down limit, 5%. And by the next day, they were opened up. So the whole point is, I'm not trying to lighten the concept of geopolitical events. What I'm trying to say is, understanding the behavior of markets is that these things tend to be very transitory in nature. So that's something really important to keep in mind. And I think the only thing that differentiates the transitory from something that has more of a lifespan to it is if that event happens around an economic recession, then you got problems.
Do you see risk for recession next year, or 2019 or 2020? What do you guys see at 1832?
So, for me personally, I don't see real high risk of recession over the next 12 months. I don't really even see high risk of recession over the next 24 months. You have a synchronized global recovery. It's the strongest growth we've seen since 2011. 96% of countries on the planet are expanding at the same time, which gives it some legs, I think. So when you look at the whole dynamic of the economics behind global growth, I don't see recession in the next 1 to 2 years. So it's something you have to pay attention to, because typically recessions are sort of associated with down 40% in the equity markets. That's a median kind of number over a 12 to 18 month period. So they are deep and long lasting. But again, abstracting from that, I don't really see that at this stage.
Right, thank you. So, we've got equity valuations at an all-time record high. As of about 1 minute ago, the Dow is up 21% this year. The S&P's up 17.25. The Nasdaq's up 26.7. And the European markets, with the exception of England, which is Britain, which is up 3.5%, they're all up basically 9 to 15%. So these are real record highs. I've heard two things discussed recently, FOMO and FOMO. A lot of us know what FOMO is, fear of missing out. And a lot of people are saying that equity valuations have been driven by people who have a fear of missing out, and they've been buying and buying because they don't want to miss out. Now, if you're a captive owner and you're in cash, or you're not happy with where you are, what about FOMO, fear of messing up? Which is another big thing, because I've heard people say, well, I don't want to invest now because the market's at a high. What happens if it pulls back? What do you think is more important? Anyone? Is it more important, the fear of missing out or the fear of messing up right now if you've got money to invest?
Probably neither. I mean, going back to the idea of market timing, it's the worst thing you could do is to think that, I'm going to try to invest for the short term and rates are on their way up, or there are all of these geopolitical events that, they're going to happen all the time. They've happened, all the time in history. It's going to happen in the future. It's, I think the only way for you to make money over the long term is to set your investment policy and be somewhat contrarian. That is the only way to make money, right? Is to buy what other people are selling. Do your homework, and geopolitical risk, as an example, creates that, right? I'm going to say you probably, most of you have met Aaron. Put your hand up, Aaron. From Orbis, who run the global equities for us. So when I say we, she shudders because I'm talking about Performa and Orbis. But we started investing in Russia when the tanks rolled into Ukraine. We're overweight in Korea right now because we don't think he's dumb enough to he goes and bombs somebody and it's all over for him, right? So he's probably not that stupid. So it creates opportunity for you in places like Korea and places like Russia, and that's the way to, if you become a herd investor, you don't have any opportunity to outperform. So I think that's certainly the, we don't think that, messing up or missing out should be part of it. You certainly want to be aware of what's happening, and how your portfolio is managed based on, rising interest rates.
I think on that point about being a contrarian is that, over the last, say, year and a half, people have steered clear of international equities until more recently, but international equities and emerging markets. And, when people say that, the market is kind of rising on air, that's absolutely not true. When you look at international equity markets, they have really attractive valuations, and the earnings are going up 25 to 30% annualized.
And as high as they are today, they're still not as high as they were before the financial crisis.
Yeah.
So they're not making all-time highs.
No,
They're making annual highs, but not all-time highs.
That's correct. So, it's, everyone says that 0% interest rates are driving all asset classes. To an extent, that's true. But at the same time, you have a very strong fundamental framework that's been driving equities around the world higher. And again, 8%, 10% earnings gains in the U.S., say for the S&P 500, is pretty good. But we're talking 25 to 30%, and look at Japan as an example, where profit margins are the highest in 70 years. These companies are profitable. They're figuring out how to do things in a very tough environment. And that is translating into great returns for share owners. So I don't think all of it's on air. There's a few stocks on air.
Sure. Well, let's and Bitcoin, and we'll talk about that maybe a little bit later or after, because I think we all have opinions on that. But I want to turn to the bond market, because obviously for captives, that's typically most of your assets. And so, people have been calling, those are people in my business, investment people, have been calling for higher rates since the Ben Bernanke taper tantrum, which occurred in May of 2013 now. It's almost ancient history. And yet, we're still waiting. But just because we've been wrong for so long doesn't mean that we shouldn't prepare. And Andy, I was wondering if you had any thoughts on how clients should prepare for higher rates if they ever come.
Yeah, I mean, I can tell you how we're positioned at the moment, and give you some reasons why we're there for sure. You know, the bond market's expensive. I'll tell you that right now. Bond market is overvalued. The bond market is not taking the Fed seriously, in my opinion. The Fed has repeatedly said that interest rates are going to keep rising in 2018, and particularly the long end of the Treasury market refuses to price that in. One of the reasons it refuses to price that in is supply and demand, and interest rates globally remaining obviously ultra low. But that tide is changing a little bit. The supply and demand environment is changing, and not to the benefit of the bond market. You know, the Europeans are talking about reduction of quantitative easing, Japanese not so much. But you know, in 2018, I actually think you can see cash outperform longer term. You know, and parts of the bond market are moving higher. So you know, you might not have lost any money owning 10-year treasuries this year. In fact, from the beginning of 2016, 10-year treasury was trading, I don't know, 240, something like that. When I left the hotel room, it was trading at 238, right? So you've just been clipping a coupon all year in 10-year treasuries. However, if you are like many captive owners and are more tied to the short end of the yield curve, the 2-year treasury over the last, since sort of the middle of September, has traded from 125 to 175, 176 actually. So, you know, you have been losing money in invested in the 2 to 3 year part of the curve, if it's purely in treasury markets.
So let me interject on that, because in this slide here, it shows that over 52% of sovereigns' government bonds are yielding less than 1%. Do you think they belong in a captive portfolio?
Global bonds, no.
Sovereigns.
No.
You know,
Global sovereigns don't belong in a U.S. dollar denominated portfolio at this point of the yield cycle at all.
Even fully hedged, right?
Even fully hedged.
Yeah,
There's no place for it. There's absolutely no reason to do. If you have a U.S. dollar portfolio, right? Your liabilities are in U.S. dollars. Your assets are in U.S. dollars. You have no place being in the international bond markets unless it's credit. Okay? So credit, meaning emerging markets, you know, things like that, that are yield-enhancing instruments hedged back to U.S. dollars, can be a worthwhile diversifying and, you know, sort of yield-clipping asset.
Just to give you sort of a sense of the loony business in the global bond market, is that if you wanted to lend money today to the Swiss government over a 50-year time horizon, you earn 0.5%. The 1-year T-bill, the 3-month T-bill rate in the U.S. is 137. 1 month, I earn 137, or I can lend my money to the Swiss government for 50 years and give them and they give me 0.5%. Or give this as an example. Only 5 years ago, there were several countries in Europe that we all thought were going bankrupt. Several sovereign nations, like Portugal, which yielded 16% on its 10-year bond at the height of the crisis. Today, the Portuguese government gives you a 10-year bond with a coupon of 1.9%, which is lower than the 10-year Treasury yield.
And lower than trend European
Correct.
inflation, not at the present moment, but
so
for a long period of time.
Yeah, I'm with you on if you're a U.S. dollar-based investor, you don't need to go global at all, period. I'm not saying that the U.S. bond market is cheap. I'm just saying that it makes way more sense to stay in U.S.
Okay, so let's move on. So
But
Hugh,
I
this
don't
is
think
one of
you-
the slides.
I think we just got to, you know, the point about rising interest rates is in asking whether they're going to rise or not going to rise. It doesn't make a whole heck of a lot of difference to you guys as captive owners. I think it's, you know, at the end of the day, your focus has to be on absolute return. Your focus has to be on preparing for rising rates. I don't care if they stay low for the next 1, 2, 3 years. It's about not losing money for a captive. And so as Andy talked about, how are you positioned? I mean, you end up being positioned somewhat short duration. You've got half of your portfolio in short-term floating rate notes, the other half's in 5 to 7 year bonds, where you're getting a decent yield on a relative basis. So you're trying to get an index type yield with a duration that's 3/4 of the benchmark, in order to preserve capital. And if you happen to underperform because rates go further down, so what? It's what we would consider to be acceptable underperformance. You've got to be focused on absolute return. So whether they go up or down at this point doesn't make a lot of difference to you. Just be prepared for rates to go up. And I think that's what's important.
All right, so to leverage off that idea, this was one of the slides that you gave, pointing out that if you had $1,000 in cash since 2005, now adjusted for inflation, your buying power is only $789. Given what's going on in the bond market, given long-term low inflation, we still do have inflation. What is the value of cash in a captive portfolio?
Yeah, I mean, it depends, right? I mean, there's certainly reasons to have cash in a portfolio. If you've got a $10 million of assets and a $10 million collateral requirement in a 114 trust, you got no choice, you're going to be in cash. Probably in a money market fund, not sitting with it under your pillow, because that's going to get you 0. Money market fund may get you 1%. But, I think or if you're in a high yield fund where spreads have been compressing and you're realizing gains in the portfolio and holding some cash tactically and keeping some powder dry until you find something else to invest in, yeah, but strategically, it doesn't make a lot of sense. Jack, as you mentioned, it's from an inflation standpoint, you're actually losing money. So from a real rate of return standpoint, it doesn't. He's going to cut me off in any second, I think, right now. The guy at the end of the table never gets much time, so I should have sat further up.
It's funny about cash, though, just back to that, is that it's exactly what you said. It's a function of where you are, because that chart showed in real terms you lost money holding cash, whereas if you're a Japanese person, you made 7.6% annualized since 2004. So as long as we have positive inflation, I think you have to be careful about holding too much cash. But yeah, I always find those charts a little deceiving.
I think there's valid reasons to hold cash in the portfolio in most interest rate cycles, because you have the ability to take advantage of either changes in the bond market or, in some cases, changes in the equity markets. In our sort of tactical asset allocation sort of framework, we have cash as an allocation. We have alternatives. We've got fixed income. We've got equities. It's a part of a portfolio, and I think it can be used as a place to put assets when you find yourself in a position where different parts of the asset markets are not valued correctly. I feel the same way about you mentioned floating rate notes, and as far as we're positioned, we own a bunch of floating rate notes. In what we do for captives, we own TIPS for captives. We're giving up a whole bunch of yield in order to own inflation-protected securities. There's only one reason for that: the market's undervaluing inflation. So when the market is undervaluing the possibility of inflation, or saying there's never going to be any more inflation in the U.S., above where we are now, which is on a core basis 1.5%. When the market's telling you that inflation forever is going to be 1.5%. And inflation protection is really cheap, that's when you buy inflation. That's when we buy it. Anyway,
all right, great. Let's go to our black swans here, including the one with Donald Trump's hair on it. So Donald Trump promised health care reform. He promised tax reductions. He promised $1 trillion in infrastructure spending. And yet he's delivered exactly none of that so far. Yet the market rallied on the potential, right post-election. Does anyone here think that it's headed for a fall if Donald Trump continues to fail to deliver on any of those items? I'll throw that out to anybody.
I think the premise of the statement is not accurate. So, and that's not a reflection on the statement as you wrote it. I think it's a reflection of people's views that the market rallied because Donald Trump became the president. The market rallied because economic growth globally was improving massively in the summer of 2016. Donald Trump happened to get elected as president, and that sent some people into a sort of hyperdrive excitement over tax reform and infrastructure and all the things that you mentioned. But in actual fact, the global economy was turning very positive. Corporate earnings at that point were relatively, well, they were okay. They weren't spectacular, but we were going into a period of very much better synchronized global economic growth that was very little recognized by the market, and corporate profitability was getting better very quickly. Margins were expanding. All of the nice things that that Miles said about where we are in the corporate profit cycle right now. I think, you know, the election of somebody like Donald Trump, who you know puts out all these big ideas, it helped. Certainly didn't hurt.
Well, I think there was a sea change in the thoughts on financial regulation and banks, which had, in spite of growing earnings in every sector, you know, bank stocks were sort of crumbling. A lot of stocks were, the markets were pulling back just into the election. I don't think there's any question that the election of Trump was a catalyst, but I agree with you completely that ultimately, and this is the next slide.
I don't think there's a causal relationship.
I think going back to inside the dynamics inside the market after Trump, you know, financials, the banks in America lit up like a Christmas tree. They were up 20% in like a week. You know, all the high effective tax rate stocks had surged after Trump became elected. The infrastructure stocks surged, but all of it, actually more than all of it, has been since priced out. So there was about a 2 or 3 week period where everyone got very excited about Trump and about what he was bringing to the American economy. And since that time, you know, after failing, that's all evaporated. But the whole point is not, the market continues to go higher not because of Trump. The market continues to go higher, as we've all alluded to here on this desk, is that when you have 10, 15% compound earnings growth, stocks are going higher. It's, you know, so we didn't need the Trump tax reform. We didn't need the financial deregulation because the economy is doing okay on its own. Like today, you know, consumer confidence hit a 17-year high in the U.S., or yesterday, whatever it was. And you know, there's a lot of things that are going right for the American economy that is helping generate good corporate earnings and to carry stock prices higher.
In fact, things are going so well that there's going to be tax reform to make it even better, apparently.
Apparently.
Because that's what's needed when everything's going great.
Right.
So.
Absolutely. Give more to the people who already have it.
But let me just say one more thing. Let me just say one more thing about the banks. Okay, and you're 100% right. But you know, the rally in financials post the election was predicated on something on zero regulation of the banks. Right? We're going to roll back Dodd-Frank, all this nonsense, which is clearly not possible because you need 60 votes to do it. We're going to all of this regulation is going away, and obviously, as everybody in this audience probably knows, you can't get 60 votes on anything. So, and then also you were going to have a steeper yield curve. And so banks were going to be all this great beneficiary of the steeper yield curve. Well, we're at the flattest yield curve we've had since 2004. So none of that has happened. And that is one of the dangers, for me, that's one of the dangers of looking at the political situation and saying, I'm buying this because of these reasons, right? You don't buy things for those reasons. You buy things for fundamental reasons. You buy things because economic growth is moving. You buy things because the demographic picture is improving. You buy things because corporate profitability is improving. You don't buy things because a new guy is in the White House.
Absolutely. And you know, what I was trying to point out with this slide is that, you know, the politicians make a lot of headlines, and certainly U.S. government policy is released on Twitter multiple times a day for those of people who follow it. But The reality is that companies are more profitable than they have ever been before, and that is what ultimately creates value. When people say the market's overvalued, they'll say, well, historically, the market's traded over the last 50 years at less than 17 times earnings. Now it's over 20, therefore it's, quote, overvalued. I'd certainly make the argument that the way businesses did business, even as recently as 10 or 15 years ago, is extremely different from the way they do them now, where they have a global reach through the internet and everything else, which to me means that they should trade at higher multiples. Let's talk about market timing. I know Hugh alluded to this before, time in the market versus timing the market, and drawdowns in the market. I know, Miles, that you provided that slide talking about the number of drawdowns in the market. Almost no one has really been consistently able to time the market, but some captive owners that I've been talking to seem to be trying. What do you guys think about that?
Well, you say almost no one. I think no one has ever been completely successful in market timing.
I was trying to be kind.
Yeah, show me that person. I'd love to see that. But yeah, no. Again, just going back to what I said before, I think market timing is just completely the wrong thing. Especially again for all of you in the audience, for captives that are concerned about not losing money. Trying to market time doesn't make any sense. I mean, you can be tactically underweight or overweight. Whether Trump had an effect on the market or not, I think, from an equity perspective, it's just too short-term thinking. I mean, we're in the 9th year of a bull market, and, historically, that's a very long time. When's that going to, is the market overvalued? Absolutely. But I think the idea of market timing, especially in an environment that we're in now, sort of a zero interest rate environment, doesn't make any sense, again, for investors that are focused on absolute return.
I just want to add to that. So the chart on the left there is something that I pulled together, and it shows each calendar year back, 70 or 80, 100 years, whatever it is.
60.
60, okay. It really doesn't matter. You can keep going back. But the point being is that in each given year, the median sell-off for the equity market, it's just the nature of the beast, is about 16%. So you remember, this year we didn't get that, all right? I'm not going to say we did. This was a very calm year, abnormally calm for equity markets, but typical is 16%. First quarter of last year, we're down 15.4%. So that's part A, is that equity markets are volatile. You have to understand that. And part B, speaking about timing the market, to Hugh's point, is that just say and he kind of shows it here, but I'm going to go even more extreme. If you missed the 10 biggest up days, single, 10, since 1927, you missed the 10 biggest up days, your portfolio is worth 30% of a buy and hold. 10 days. So for people who are trying to time the market, I'm not sure 10 single up days. I don't have a crystal ball. But as people have alluded to, timing the market versus timing the market and all that sort of stuff, I think it's important to think about and not look at your screens, not look at CNN, not look at all this stuff every day, because what it's going to give you is just a lot of post-traumatic stress disorder when it comes to investing in the equity markets. But over time, it's not been a bad gig.
You have $100 billion under management, and you don't have a crystal ball?
Sorry, I don't.
I just wanted to point out, you see all these dots above and below the line. Every single year, to Miles' point, there was a drawdown of some amount in the market. In other words, a sell-off or pullback, whatever you want to use the term. And yet, in the last 60 years in this chart, there was only 18 years where the market actually ended up lower. So 42 of the years, even with this drawdown, the market still ended higher, so sort of 2/3 of the time. And in this chart over here, you can sort of interpolate that in the last 30 years that this chart covers, the average rate of return with a buy and hold strategy was 8.4%. If you missed 15 days, you cut your return in half. The 15 best days, that's 3 trading weeks. it's hard to tell which one of those days it's going to be. The people who sold stocks right
Although at
before the
1832,
election.
we do have a crystal ball.
Yeah, the people who sold stocks right before the election because they were worried either way on how it was going to come out, they missed a lot.
Can I, there's something that, like, the next chart here is missing from the presentation, which we don't have, we don't have in here, I just realized. So the next chart in the presentation is, well, what do returns look like from this valuation point, right? So I think you've heard us all talk about staying the course, corporate profitability is good, but what we haven't talked about really, and I think maybe just touch on it, is from this valuation point, things look less good, okay? So on a forward-looking sort of capital market expectation basis. So when, captive owners in the audience, if you have an investment manager, you're looking for an investment manager, that guy, that firm, whatever, they should have an expectation of the future, right? They should have some kind of a model for forward-looking capital markets expectation. Where valuations are in equity markets now says something about where returns can be going forward into the future, okay? It says nothing about volatility. Volatility is an assumed level. But this valuation point generally means lower expected returns in the future. So while we've been pretty upbeat about the economic situation and the corporate earnings situation, I don't want you to take that as our expectations are, yeah, okay, equity markets can do 7 to 9% a year for the next 10, 15 years. We don't believe that. From this valuation point, we think equity market returns, particularly in developed markets, are constrained going forward.
I think that's a great point. And when we look around the world, it's U.S. equity markets that are the most egregiously valued. Like, let's be honest about it. But when you look internationally, so if you want to put numbers around it, maybe 1 to 3%, maybe 2 to 4% total returns for equity markets over the next decade in the U.S. I think you get 5 to 7, maybe even a little higher in international markets, given what you say is a starting point valuation, which is very challenged in the U.S. There's no two ways about it. So for me, I've been looking more for our company. We've been looking more at international markets because they have much more attractive relative valuations, much more depressed margins that can expand, whereas the U.S. profit margins are already in the stratosphere. So we think there's better prospects internationally.
All right, that's great. I mean, I think we probably want to get back on schedule, so our time is just about up now. Does anybody have any questions? We've covered everything.
Yeah, well, I mean, everybody's always going to be wrong on long-term capital markets assumptions. So let me just frame that for you just a tad. So on a long-term capital market assumption, you're using a modeling, some kind of a modeling device, right? To say to give you sort of a future income stream, right? Whether that's gains in equity markets through appreciation in dividends or bond yield or yield on cash, whatever. It's a stream of earnings over time, right? I think that people who give you a 5 to 7 year capital markets expectation are not doing it right, if you want to look at it that way, because you really need to be kind of over a whole market cycle. So this is an especially relevant time to be talking about this, because the economic cycle, this cycle, right, post credit crisis, has been a very long expansion, right? And all you hear all day long is the expansion is long, the expansion is longer than normal. When is it going to, end, die of its own accord, which we don't think happens, but that's another discussion entirely. If you don't go further out, right, if you don't say, okay, this is a 10, 15-year sort of long-term, and it's not a prediction, because you know you're going to be wrong. But, and I agree with you, equities historically are volatile, as Miles said. S&P volatility is like 16% historically, going back forever, right? International stocks more than that. Japan, 19, 20%. So I mean, the markets are volatile, and that's not changing, but your return expectations are changing. So yeah, if you're looking at it sort of on an efficient frontier, or whatever this pictorial, theoretical, academic efficient frontier is, right? That's definitely compressed, right, in this market. It's certainly compressed in fixed income, and we would argue that from this valuation point, the equities part is compressed as well. And it's very, very important, and Hugh touched on this as well. Hugh touched on the strategic asset allocation part of the sort of investment plan. It's extremely important to go into this with reasonable expectations and well-informed probabilistic expectations. See, the Vanguard guys are in the audience. They'll be glad I said probabilistic, but because they do it on a probability-based sort of metric. It works that way. You can't say, oh, equities are going to return 5% for the next 15 years and be right about it. That's impossible. But you can say with some degree of certainty at this valuation point, with these growth factors, with this inflation, with this demographic backdrop in a country, you can get to a certain point, and that point has ranges around it. In our view, those ranges are lower, so you need to have conversations with captive owners that say, okay, well, I know you made 19% last year. We're not talking about last year. We're talking about what you can expect going forward.
Here's what I say about market return expectations. Any forecasts are full of baloney. So I take a very simple approach, and my approach is as follows. Say someone asks me, Miles, you have to make sure that no one dies in an earthquake. All right? So what is my job if someone says, Miles, make sure no one's died in an earthquake? Is my job to predict the next earthquake? Is my job to predict the magnitude, the location of the next earthquake? No. If my job is to ensure no one dies in an earthquake, I simply move them out of the frickin' earthquake zone. All right? So when it comes to these sorts of things, understand what you're involved in. Equity markets are volatile but rewarding over time. That's it. So do we need if your clients can never take a 50% loss, never be in equity markets. Period. That's it. So I take a very simple approach. It's not about predicting the outcome. It's about control. The only thing I have is control of my exposure to an outcome, not the outcome itself. I can't
Just like
predict the
insurance.
earthquake. Right.
Yeah.
Exactly like insurance. There you go.
Any other questions?
the right
'Cause
conference.
otherwise we're going to wrap up. Any other questions? Thank you all for coming. I appreciate it.
Thank you very much, everyone.